The first rule of volatility is understanding how you adjust your risk management profile. The second thing I'd look for when I'm looking at volatile markets is there an underlying trend. If you look at the first couple of weeks of 2016, we saw massive volatility, and you could see that through the daily ranges. If you look at the ATR, the average true range, you could see huge range expansion. But the great thing for day traders at the time is you were seeing very strong trends. If you look at oil, for example, if you look at some of the currency markets, you're seeing very, very strong trends. And you would have ridden the trend, you would have aligned your strategy with the trend as part of that technical overlay, but your stop loss would have had to be further away because every short covering rally was slightly higher. And that's what we're looking for. We're looking for the trend and how markets are trending, but at the same time the volatility, and we can measure that through things like the VIX, through the average true range, through the IG platform, and you can just get a sense of how to trade through that. So it's, I think the volatility is key in terms of adjusting your stop losses and your risk management. But of course, you combine that with other technical overlays such as trend following systems. What I think is really interesting about volatility is how traders and different market participants actually adjust their strategies. When you see periods of very, very low volatility, you'll see people looking for income structures. People will look for yield, and that's when you generally see high yielding stocks, boring stocks, utility stocks doing very nicely. People are saying, we've got sideways trading markets, but we want to be paid effectively to be in a position. So that's where we hunt out yield chasing stocks. Some of these utilities, some of the telcos, for example, will do very nicely. Some of the high yielding currencies will do better than others, such as the Australian dollar, some of the Latin American countries, because you're getting paid to be in the position. But when you see a period of extreme volatility or heightened volatility, traders will generally go to safe haven assets. And that's what you see. Things like the Japanese yen, you'll see the Swiss franc doing quite nicely. US treasuries will suddenly be bid up. People are looking for that safety. So people change their strategy from one where you're getting that carry structure in the FX market, you're getting the income from the equity market, and that strategy becomes unwound very, very quickly, and people will be looking at shorting opportunities much more quickly. People will take that time frames are much lower, and I think just it's really interesting to see how volatility changes the asset allocation in markets as well. I think volatility for a short-term trader is absolutely what we'd live for, to be honest. Volatility creates disagreement in markets, it creates divergence in markets, it means you get misalignment in prices, and of course that's what we do as traders. We are picking different levels, we're making anomalies in pricing, and that's what we're trying to do. I mean, algorithmic traders do that, the high frequency guys do that. Us as discretionary human beings can do that as well. We're looking for bad pricings in markets. That's effectively what we're doing. Whether you take a discretionary view or you set a system to do that, you're trying to find a bad price. And that's what volatility does. It creates huge divergences in prices, and volatility therefore creates an opportunity. So I love volatility.